You look at the screen, hoping the minus sign in front of your balance might disappear if you blink. You overdrafted by exactly $4 for a coffee you forgot was scheduled to charge. Look at this scale. The banking system ignores the actual size of your mistake. The math simply dictates that you crossed a threshold, so the system automatically drops a $35 penalty right on top of it. Then, a $7 charge for a subscription you forgot to cancel processes. The system sees you are already negative and triggers the exact same $35 penalty again. Your $4 error just became a $77 debt to the very institution that noticed you were broke. The math starts spiraling in directions you didn't authorize. Your rent payment fails, your landlord adds a late fee, and your phone bill bounces. You walk past the place you usually eat and tell your coworkers you already had lunch. Hunger at this level is silent. At this first tier of banking, the penalty for lacking money is an automated algorithm specifically designed to ensure you lose even more of it. You work 20 hours of overtime to pull the account back to a positive $200, but the system quietly withdraws a $12 maintenance fee anyway, simply because you failed to meet a $1,500 minimum balance. You are paying a bank to hold the money you barely have. When you apply for a credit card, they offer you a secured one. The institution requires you to hand over $300 of your own cash as collateral, just so they can lend it right back to you and charge 24% interest for the privilege. You walk into the physical branch to ask about the fees. The teller is smiling at the person in front of you, but when you step up, that warmth vanishes. It becomes a trained, cold professionalism. You aren't insulted, but you are processed and moved through like luggage on a belt. It is tempting to think the customer service here is broken, but the machine is perfectly calibrated. The bank has categorized you. You aren't a customer. You are a numerical risk score with shoes. Reach $2,000 and the dynamic flips. A consistent pattern of direct deposits triggers the system to automatically waive the maintenance fees that previously drained your account. You didn't change, but your behavior finally matches a profile that earns the bank money. The secured card offers stop. Instead, real, pre-approved credit cards arrive in the mail with your name printed in metallic ink. The identical institution that wouldn't trust you 8 months ago is now eagerly sending you unsecured limits. At $15,000, the automated indifference is replaced by human intervention. A dedicated relationship banker calls you, giving you a direct line and asking about your goals. The system that used to put you on hold for 40 minutes is now dialing your number first thing on a Tuesday. This chart shows exactly what happens to the cost of borrowing as your balance grows. The moment your account crosses $15,000, the interest rate on a standard auto loan drops from 11% to 6.8%. The actual price of money gets cheaper. You didn't negotiate that rate drop. These perks are not rewards for good behavior. They are activated because your account balance represents a profitable profile the bank can actively sell products to. Hit $80,000 and your statements start labeling you a preferred client. Your relationship banker uses heavily trained personalization, remembering your birthday or details about your family. The bank teaches them to remember small things because small things retain accounts. The traditional lending process runs in reverse. Instead of you applying, the bank pre-approves you for a $400,000 mortgage. They decide what you can afford and offer you the money before you have even selected a house. At $500,000, the physical geography of the relationship changes. You no longer go to the bank. Wealth management colleagues travel directly to your office, bringing printed reports in leather folders. They aren't trying to sell you a product anymore. A product is a one-time transaction. They are offering a consultation, which establishes a long-term dependency on their advice. The selling already happened, you just didn't notice it. Past $500,000, the institution stops trying to extract immediate fees. Their entire focus shifts to defending your account from competitors. You are no longer a consumer to be sold to. You have transitioned into an asset to be protected. At $5 million, you enter private banking. Standard rules dissolve. You have a private banker managing fewer than 20 accounts, and the rigid policies that apply at the branch level are actively bent and negotiated based entirely on your relationship. By $25 million, deals and interest rates become entirely bespoke. They are drafted in private conference rooms, tailored specifically to your individual timeline. Access flips completely. You do not apply for investments at this tier. Investments apply for your participation long before they are ever made public. The dynamic of influence reaches its peak. The bank's top executives fly out to your city to consult you, actively seeking your advice on global markets and asking how they should design their future products. At this elite level, you are no longer a customer to be served. You are a structural partner shaping the institution itself. Meanwhile, someone else is staring at a screen with a negative $4 balance. They are sitting at a desk listening to looped, unhelpful hold music, waiting for a voice that will only read from a script. The exact same institution charging them a penalty for a lack of funds is the one that will fly executives out to ask that $25 million account for opinions on emerging markets. There is a cold philosophical truth hidden at every level of this structure. The bank was never intentionally cruel when the account was empty. It was simply indifferent, and indifference at scale looks exactly like cruelty. You are the identical human being at every single tier. The institution never actually changes how it operates. It simply executes an algorithm, deciding exactly who you are based entirely on the number printed next to your name.